Hey everyone, welcome back to the channel. Today we're tackling one of the most confusing phenomena in investing. Why do stocks sometimes crash right after companies announce record-breaking profits? You'd think amazing earnings would send stock prices soaring, but often the opposite happens. Companies report their best quarter ever and their stock plummets 10%, 20%, or even more. This seems completely backwards and leaves investors scratching their heads. Drop a comment below telling me if you've ever been caught off guard when a stock you own dropped despite great earnings. Now let's unravel this mystery. The single most important concept for understanding why stocks fall after record profits is this. Stock markets don't price what has already happened, they price what investors expect to happen in the future. This forward-looking nature explains most seemingly irrational stock price movements. When a company announces record profits, that's historical data. It tells you what happened last quarter or last year. But stock prices reflect expectations about future earnings, growth, and profitability. By the time earnings are announced, the market has already formed expectations and priced them in. If reality matches expectations, the stock might barely move. If reality falls short of expectations, the stock can crash even if the actual numbers are fantastic. This is why you'll see headlines like, Company X beats earnings estimates, but stock falls 15%. The company might have earned $2 per share when analysts expected $1.80, which sounds great, but if investors were secretly hoping for $2.50, or if the company's guidance for next quarter disappoints, the stock can plummet despite beating official estimates. Stock valuation is essentially the present value of all future cash flows a company will ever make. When you buy a stock, you're not buying last quarter's profits, you're buying a share of every future profit the company will ever make. If those future profits look smaller than previously expected, the stock loses value today, regardless of how good current profits are. The market also distinguishes between earnings growth and absolute earnings levels. A company might report record profits of $10 billion, but if those profits grew 5% while investors expected 15% growth, that's disappointing. The market cares more about the trajectory than the absolute number. Understanding that stocks are forward-looking vehicles transforms how you interpret market reactions. That confusing stock drop after record earnings suddenly makes sense. The market was expecting even better, or the future outlook dimmed, or the profits came from unsustainable sources.
Expectations management is critical, and the gap between expectations and reality drives stock price reactions far more than absolute performance numbers. Wall Street analysts play a crucial role in setting expectations. Major investment banks employ analysts who cover specific companies, build financial models, and publish earnings estimates. The consensus of these estimates becomes the benchmark against which companies are judged. Companies provide guidance, their own forecasts of future performance. Management knows that beating guidance makes Wall Street happy, while missing it causes punishment, so they carefully manage these expectations. Many companies practice sandbagging, providing conservative guidance they're confident they can beat. The beat and raise pattern has become almost expected by investors. Companies are supposed to beat current quarter estimates and raise guidance for future quarters. Just beating estimates without raising guidance can disappoint. Investors want both, and anything less can trigger selling. When a company announces record profits but provides disappointing guidance for the next quarter or year, the stock often crashes. The message to the market is, yes, we had a great quarter, but don't expect it to continue. This forward-looking disappointment overwhelms backward-looking success. The magnitude of beats and misses matters. Beating estimates by 1% is different from beating by 20%. A small beat might be seen as just meeting expectations, while a large beat suggests the company is significantly undervalued. Whisper numbers add another layer of complexity. Beyond official analyst estimates, there are unofficial whisper numbers circulating among professional traders. A company can beat official estimates but miss whisper numbers, causing the stock to fall as professional traders who bought in anticipation sell in disappointment. Quality of earnings matters as much as quantity. Did record profits come from sustainable revenue growth or one-time tax benefits? From selling more products or cutting costs? Investors dig into the details, and impressive headline numbers can hide concerning underlying trends. Conference calls after earnings often matter more than the numbers themselves. Management's tone, their answers to analyst questions, and subtle hints about business conditions can dramatically shift expectations. A hesitant CEO can tank a stock even after reporting good numbers.
Even when companies deliver record profits and beat expectations, stock prices can fall if valuation multiples contract.
The price-to-earnings ratio is the most common valuation metric, calculated by dividing stock price by earnings per share. A stock trading at $100 with earnings of $5 per share has a PE of 20. A stock can report record earnings but still fall if its PE multiple compresses. Imagine a company trading at a PE of 40 because investors expect rapid growth. It reports record earnings of $5 per share, growing 30% year over year. But if investor sentiment shifts and they decide the stock should trade at a PE of 30 instead, the stock falls from $200 to $150 despite those record earnings. Multiple expansion and contraction is driven by numerous factors. Interest rates are crucial. When rates rise, future earnings are worth less in present value terms, compressing multiples. Growth expectations matter. If growth is expected to slow, multiples contract. Market sentiment matters. In bear markets, multiples compress across the board. The growth at any price mentality of bull markets leads to extreme multiple expansion. Stocks can trade at PE ratios of 50, 100, or higher. When sentiment shifts, these multiples can collapse brutally. A company growing earnings 50% annually might see its stock cut in half if the multiple contracts from 80 to 40. Different sectors command different multiples. Technology companies typically trade at higher multiples than utilities because of growth expectations. When sector rotation occurs, investors moving from growth to value stocks, multiples can shift dramatically. A tech company might report record earnings but see its stock fall if investors are rotating out of tech broadly. Market context is everything. The same earnings report that would send a stock soaring in a bull market might cause it to fall in a bear market. During downturns, investors become more skeptical and risk-averse. They're less willing to pay high multiples even for great companies. The law of large numbers affects multiples. As companies grow enormous, maintaining high growth rates becomes mathematically difficult. A $10 billion company can potentially double, but a $1 trillion company doubling seems far less plausible. So, even as large companies report record profits, their multiples may compress because investors recognize that growth must slow. Beyond rational analysis, human psychology and market sentiment play enormous roles in how stocks react to earnings. The buy the rumor, sell the news phenomenon is deeply rooted in investor psychology. As earnings approach, optimistic investors buy in anticipation. This buying pushes the price up before the announcement. When good news is confirmed, these investors take profits and the stock falls. Fear of missing out, FOMO, can drive stocks to unsustainable levels before earnings. Retail investors see a stock rising and jump in, afraid of missing gains. When earnings are announced, even excellent results can't sustain the momentum because the FOMO buying was irrational. Herd behavior amplifies movements in both directions. When a few large investors or influential analysts react negatively to an earnings report, others follow. No one wants to be the last one holding when everyone else is selling. This creates cascading selling that can drive a stock down far more than the news warrants. Recency bias causes investors to overweight recent trends. If a company has beaten estimates for several consecutive quarters, investors may assume this will continue forever. When growth finally slows, even to still impressive levels, the disappointment is severe. Loss aversion is a powerful psychological force. Studies show people feel losses about twice as strongly as equivalent gains. When investors are sitting on profits going into earnings, they may be quick to sell at any hint of disappointment to lock in gains. Narrative changes can overwhelm fundamentals. Markets love stories, and stocks often trade on narratives rather than pure numbers. If the narrative shifts from unstoppable growth to growth is maturing, the stock can fall dramatically even on record earnings.
Technical factors and market mechanics can cause stocks to fall after earnings regardless of how good the numbers are. Institutional profit-taking represents a major pressure. Large institutional investors often accumulate positions over time. When a stock has had a strong run leading up to earnings, institutions may use the earnings announcement as an exit opportunity. Options expiration dynamics create unusual trading patterns. Many investors buy call options before earnings, hoping for a jump. After earnings are announced and implied volatility collapses, options traders close positions regardless of the outcome. This can create selling pressure unrelated to earnings quality. Algorithm-driven trading amplifies movements in both directions. High-frequency trading algorithms react instantly to earnings beats or misses, buying or selling massive volumes in milliseconds.
These algorithms can push stocks far beyond rational levels initially. Later, as humans digest details, stocks often retrace these moves. Liquidity conditions matter enormously. A stock might fall simply due to an imbalance between buyers and sellers. If large investors want to sell, but there aren't enough buyers at the current price, the price must fall until buyers appear. This is mechanical, unrelated to whether earnings were actually good. Margin calls and stop-loss orders can create downward spirals. When a stock starts falling after earnings, investors who bought on margin may receive margin calls requiring them to sell. Others have stop-loss orders that automatically sell at certain levels. These forced sales push prices down further.
Understanding why stocks fall after record profits has important practical implications. Never buy a stock just because earnings are coming up. If you're right about earnings being good, that expectation is likely already priced in. The risk-reward often doesn't favor pre-earnings buying. Focus on long-term fundamentals rather than quarterly results. If you believe in a company's multi-year potential, short-term reactions become less important. Quarterly noise can create opportunities to buy quality companies at temporary discounts. Look beyond headline numbers to understand earnings quality. Don't just react to whether a company beat or missed. Read the full report, listen to the conference call, and analyze whether earnings came from sustainable sources. Be aware of valuation before earnings. If a stock has already run up 50% in anticipation, those expectations are priced in. Even great results might not justify further gains. Context matters more than absolute numbers. Watch for overreactions that create opportunities. When a fundamentally strong company sees its stock crash 15 to 20% on earnings that actually weren't that bad, that's often an overreaction worth buying. The market frequently overreacts initially, then corrects. Don't assume you're smarter than the market. If a stock falls on what seem like great earnings, resist the urge to immediately conclude the market is wrong. Take time to understand why it reacted negatively. The biggest lesson is that stock prices are forward-looking, expectations-driven, and often irrational in the short term. Record profits are backward-looking facts. The market cares about what comes next. We've explored why stocks fall after record profits from multiple angles. The forward-looking nature of markets means past performance matters less than future expectations. The role of expectations and guidance means beating estimates often isn't enough. Valuation multiples can contract even as earnings grow. Market sentiment creates irrational reactions driven by FOMO, fear, and herd behavior. Technical factors like profit-taking and algorithmic trading can overwhelm fundamentals. Understanding these dynamics transforms you from a confused observer to an informed investor. When you see a stock crater on seemingly great earnings, you now have frameworks to analyze why. Maybe guidance disappointed, maybe the multiple was stretched, maybe it was just profit-taking. This knowledge helps you avoid painful mistakes like buying into pre-earnings hype or panic selling quality companies that drop on technical factors. It helps you identify opportunities when the market overreacts. Most importantly, understanding why stocks fall after record profits reinforces that investing successfully requires looking forward, not backward. What happened last quarter is far less important than what will happen next quarter and next year. Now I want to hear from you. Have you ever experienced a stock plummeting after earnings that seemed good? How did you react? Do you have a strategy for handling earnings season? Share your experiences in the comments below. If you found this explanation valuable, please give this video a thumbs up and share it with anyone trying to understand how stock markets really work. Make sure you're subscribed with notifications on so you never miss our deep dives into investing and finance. Thank you so much for watching, and I'll see you in the next video.